What if I told you that you don't need thousands of dollars or a finance degree to start investing in the stock market? That with just $100, you can actually begin building real wealth from your phone. Today, in this video, I'll break down exactly how to start investing smartly, safely, and confidently, understanding what stocks really are. Before jumping in, let's clear the biggest confusion. What exactly are stocks? A stock represents a tiny piece of ownership in a company. When you buy a stock, you're not just gambling on a number going up, you're becoming a partial owner of that business. You own a slice of its profits, its growth, and even its reputation. Let's take Apple as an example. If you buy one share of Apple, you technically own a piece of that company. When Apple launches new products, earns profits, and grows its brand, your share increases in value too. It's like being part of the journey of the world's most successful companies. So remember this simple principle. When the company grows, your wealth grows too. Why starting with $100 is more than enough. A lot of beginners believe they need $1,000 or even $10,000 to begin investing. That's completely false. Today, thanks to fractional investing, you can start with as little as $1 or $5. Fractional investing means you can buy a small portion of a stock instead of the whole share. So, even if a single share of Amazon costs $3,000, you can still invest your $100 and own a piece of it. Modern platforms like Robinhood, Webull, Fidelity, or eToro make this incredibly easy. The barrier to entry has never been lower. The most important thing isn't the amount you start with, it's a habit you build. Consistent investing, even with small amounts, can grow into something massive over time because of compounding returns. It's not about timing the market, it's about time in the market. Set a clear financial goal before you start. Before you invest a single dollar, ask yourself, why am I investing? Are you saving for retirement, trying to build long-term wealth, or simply learning how the market works? Having a clear purpose changes everything. It shapes how you invest, what you invest in, and how patient you will be. If your goal is long-term growth, then investing in broad, diversified funds or stable companies makes sense. If your goal is short-term learning, you might experiment with individual companies to understand how stocks behave. Without a goal, you'll end up following hype, trends, and random stock tips. And that's the fastest way to lose money. Choose the right investment platform, brokerage account. To invest in stocks, you need a brokerage account. This is like your digital bridge to the stock market. Here are a few beginner-friendly platforms to consider. Robinhood, simple and clean interface, zero trading fees. Webull, great for both learning and analyzing charts. Fidelity, trusted, long-term, and beginner safe. Charles Schwab, excellent for long-term investors and retirement planners. When choosing your platform, look for no commission fees, fractional share options, automatic dividend reinvestment, called DRIP, strong mobile app and learning tools. Once you've chosen your platform, sign up, connect your bank, and deposit your first $100. Congratulations, you've already taken the hardest step, getting started. Decide what to invest in, stocks or ETFs. Now comes the exciting part, choosing where your money goes. Option 1, individual stocks. These are shares of a single company, like Apple, Tesla, or McDonald's. They are great if you believe strongly in certain businesses or industries. Pros, easy to understand, potentially high returns. Cons, high risk. If one company performs poorly, your investment suffers. Option 2, ETFs, exchange-traded funds. ETFs are baskets of many stocks grouped together. When you buy one ETF, you invest in hundreds of companies at once. For example, the S&P 500 ETF, VOO or SPY, includes 500 of the biggest U.S. companies, like Apple, Microsoft, Amazon, and Google. That means even if one company underperforms, the others help balance it out. For beginners, ETFs are often the smartest choice because they offer instant diversification and low risk. If you're starting with $100, consider putting it all into an S&P 500 ETF. You'll own a piece of America's top companies right away. Learn the power of risk management and diversification. Every investment involves risk. The stock market goes up and down daily. That's normal. The key to surviving and growing is diversification. spreading your money across different companies or sectors so one loss doesn't destroy your portfolio. If you're investing regularly, here's a simple example strategy for your $100 each month. 60% into a broad market ETF like VOO, 20% into a tech ETF like QQQ, 20% into a single company you believe in. This approach balances safety and growth. It also helps you stay calm when markets dip, because you're not relying on just one stock. Start small but stay consistent, dollar cost averaging. Consistency beats intensity in investing. Even if you only invest $100 every month, it can add up over time through a strategy called dollar cost averaging, DCA. Here's how it works. You invest a fixed amount every month, no matter what the market's doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, your average cost balances out, reducing your risk. If you keep investing $100 monthly and your portfolio grows at an average of 10% annually, in 10 years, you could have over $19,000, all from a simple, consistent habit. Think long-term. Don't panic in market dips. The stock market builds wealth slowly but surely. Prices rise and fall. That's normal. Don't panic or sell during dips. Think like an owner, not a trader. Stay consistent and patient, because time and compounding are your greatest investing advantages. Keep learning. Knowledge multiplies money. Your first $100 is your classroom fee to the world of investing. From here, your best investment will be in your own financial education. Here's how to keep learning. Watch credible YouTube finance channels, Graham Stephan, Andre Jick, Nate O'Brien. Read books like The Intelligent Investor or Rich Dad, Poor Dad. Learn basic financial terms like dividends, POE ratio, and market cap. Reinvest your profits. Let compounding work its magic. When your investments earn dividends or profits, don't withdraw them, reinvest them. This is how you unlock the power of compounding. Let's say you invest $100 and it grows to $110. Instead of taking out that $10, reinvest it. Now your future gains grow on $110, not $100. That small habit accelerates your growth exponentially over years. Albert Einstein called compounding the eighth wonder of the world. Avoid these common beginner mistakes. To protect your progress, avoid these traps. Don't chase hot stocks or viral tips on social media. Don't invest money you'll need next month. Invest what you can afford to leave alone. Don't panic when the market dips. Do your own research. Stay patient. Focus on building habits, not chasing trends. Remember, investing is 80% psychology, 20% math. Growing beyond $100. What's next? Once you master investing your first $100, make it a monthly habit. Automate deposits. Increase amounts as income grows, and diversify into ETFs or bonds. Focus on steady progress, not perfection, because starting early builds experience, confidence, and long-term wealth. Don't forget to hit like, share, and subscribe.